Hey, in this week's post talking about Social Security, I want to tackle the whole issue of planning for, optimizing how to reduce the amount of your Social Security benefits that get subject to taxation. So there's a unique opportunity, there's a unique planning opportunity for individuals who are delaying to take their Social Security until a little bit later. Let's say, for example, age 70. A lot of people will retire, let's say at 62 or maybe 65, and choose to delay taking their Social Security benefits until a later age. Well, that creates a very unique opportunity, which we have here on our whiteboard. Let's say the individual retires at 65 and doesn't begin collecting their Social Security benefits till 70. Well, they've got a little bit of what I would call an income gap, in which they're not getting Social Security benefits, or they're getting minimal Social Security benefits, and they have an opportunity, and the opportunity is to begin taking some retirement account withdrawals during that gap time period. Now, why would they do that? What's the significance of doing that? Well, if I'm able to reduce, of course, if I have an income gap, I'm going to need to get it from somewhere. I could get it from my IRA accounts or 401k accounts. If I do take it from those accounts, it's helping me in a couple ways. Obviously, it's helping me fill the income gap, but number two is it's reducing my IRA account balances. Why is that a good thing? Well, it deals with the required minimum distribution amounts that are going to have to come out later on when I'm 70. So if I'm systematically taking a little bit more out of my retirement accounts while I get up to this age 70, I have a couple of benefits that ultimately happen to my account or to my situation. One is, if I activate my higher Social Security benefits there at 70, I'm not going to need to take as much out of my IRA and 401k accounts after that point. And so the maximized Social Security plus the required amount that the IRS is going to have me take out of my IRA accounts because of required minimum distributions, it puts me in a good position when they test the taxation of my Social Security benefit. Now, it's based upon what's called provisional income. If I can get my provisional income as a married couple below $32,000, then I am in an incredible place of not having any taxation of my Social Security benefits. So what's provisional income? It's half the Social Security benefits plus any other sources of income, which include IRA distributions, required minimum distributions, and such. So if I withdraw a little bit more in the IRA accounts during this waiting period, I'm going to reduce my future required minimum distributions so that when I get to that age 70 and beyond, I've got all my Social Security benefits, I've maximized that, and so my provisional income test, half of the benefits, Social Security benefits, plus the IRA withdrawals, a lot of times if I do some good planning, I can get that below $32,000 a year. If it's below the $32,000 a year, every single Social Security dollar I get, not taxed at the federal level. Also, not taxed at the state level, generally speaking, for a lot of states. Once I get over the $44,000 threshold of provisional income, then I'm in kind of a tough spot because 85% of those benefits end up going on the tax return and being taxable. So if I'm going to delay, and I recommend a lot of people delay for a lot of reasons, during the wait, if you have that income gap, taking distributions from your IRA accounts can really be helpful toward not having your Social Security in the future, which you're delaying, be taxed at that higher level. Now, some people get a little bit nervous about taking larger distributions while they're waiting until age 70. Keep in mind, when you get to S70 and if you maximize Social Security benefits, you're not going to need to take as much out of the IRA accounts. So it's okay that it's a little lopsided on the front end in order to make it work on the back end. Now, very interesting at this time of recording, we have some proposed legislation that may make these $44,000 and $32,000 income thresholds for the taxation of Social Security moot. They are talking about increasing this as a married couple up to $100,000 for the provisional income test. If that occurs, then certainly new different types of tax planning opportunities are going to be available, more opportunities. It'll be really a good thing, in my opinion, for retirees. They'll be able to get more of their Social Security benefits not from being taxed at the federal level. So anyway, just to summarize, if you're delaying Social Security, if you can take some distributions from the IRA accounts, kind of fill up those lower brackets, in order that once you've activated your Social Security later, less of it can be subject to taxation due to the fact that you need to take less money out of your retirement accounts at that point. It's a good tax planning strategy. So work with your accountant, work with your financial planner in a way to make that work for you.